David's a friend, and Michael, a lot of respect the whole network has for you, the whole industry has for both you two. So with that being said, I'll just be quiet and let you guys roll.
All right. Well, I'm going to turn this over to Mike. Let me do a quick introduction to all of you. And great to be with you again. I feel really honored we could get Mike to join us. Mike is the Chief Economist, Senior Vice President for Research, Industry Technology at the MBA in Washington. His overall expertise is thorough. It covers responsibility for overseeing the MBA's industry surveys, its benchmarking studies, economics and mortgage origination forecasts, which, by the way, are critical data that I pull every month from the MBA site, industry technology efforts, policy developments for both single family and commercial multifamily markets. He's also a member of the board of directors of MISMO and is on the membership committee for MERS. Prior to joining the MBA, Mike has a long history in the industry. He had senior economist roles at both Washington Mutual, if you all remember WAMU, and Fannie Mae. He received his PhD in economics from Johns Hopkins and his BA in economics from William and Mary. He's also served as an adjunct professor at the University of Washington, Johns Hopkins, GW, as well as Georgetown University. So Mike is an incredible economist. I'm just going to tell a quick story, Mike. Sorry. When I first joined the MBA, I got a call from my mentor in mortgage banking, who had taught me everything about capital markets when I was at Freddie Mac. And all he had to say to me is, he goes, you got Mike Fratantoni on your staff. And I said, yeah, Mike? And he goes, he's the smartest economist in this country. And I thought that was a hell of a compliment, and I use it over and over again. So Mike, thank you for joining us. I know a lot of people have a lot of questions. How can rates be heading up the last couple of months, or up and down? And people thinking they're still going to come down in the future. But I know people are very interested in hearing what you have to say. So turning it over to you, dude.
All right. Thanks, Dave. Appreciate the introduction, and good to see everybody here today. So let me just kick off with sort of our thoughts on where the broader economy is headed. And as Dave said, obviously understand the main interest here is what are the implications then for rates. Then I'll dive into a bit more on the housing market. And as Steve indicated, sort of the other question is, when are people going to start listing some properties? And how are we going to handle the fact that borrowers are just so frustrated by the lack of inventory out there? So those are, I say, sort of the two main questions today, but I'll dive into a little more detail. So to Dave's main point, why do people like me keep thinking that the economy is likely to slow, and with that, rates are likely to move down from here? It's because we keep looking at data like what I'm showing here on slide 2. So this is the ISM data looking at the manufacturing sector in the economy, the services sector of the economy, and really beginning in middle of 22, you have all these businesses reporting that they're ordering less equipment, they're slowing the pace of activity, they're hiring fewer workers, they're seeing less price pressure in the system. And these kind of surveys tend to be really, really pretty good indicators of where the economy is going to be 6-9 months down the road. So we've seen this steady decline in the rate of activity. It's again, one of the things I look at most closely. Beyond that, we have what's happening with respect to the availability of credit. This is data from the Fed Senior Loan Officer Survey. Really, the question here is for a bank senior credit officer, in the last period of time, did you tighten credit, loosen credit, or leave it the same? And what this is showing is through the course of the latter half of 22 and into 23, you had more banks tightening credit than loosening credit over the course of that time period. And this was even happening before the bank failures that we had in March of this year, and then again in May with First Republic. So this is another one of those leading indicators that economists put a lot of weight on, because what you're essentially doing is turning off the supply of credit to the business sector and the consumer sector, both reducing availability and increasing the cost of that credit. That eventually shows up as a slower pace of economic activity. So both of these things, the slowdown in the corporate sector with the ISM data, the tightening of bank credit, the sudden failures of bank that we saw earlier this year, really a result of the Fed increasing short rates 5 points in a very short period of time. Why did they do that? It's all here on this page. For the first time in 40 years, inflation got away from them. We had inflation last year peaking at about 9% for headline inflation, over 6% for core inflation. You can see on the right, why they were fooled initially. Initially, it was really reflecting supply chain constraints where various commodities were having difficulty getting delivered in a timely basis and prices jumping for just about everything a business could order. That was short-lived, but then the inflation got into the rest of the economy, including the cost of shelter and the cost of non-shelter services. So the Fed stamped on the brake, increased rates by 75 basis points, and then 50, then 25. In the most recent meeting in June, they did take either a pause or a skip. We'll talk more about that in a minute, because it looks like some progress is being made. But if you listen to Federal Reserve speakers, a fair amount of debate about whether they have hiked rates enough to bring inflation back down to their 2% goal. And then that gets to the question of, well, what's really going to be driving that? And I mentioned on the right here that while shelter costs are still elevated, that's really a lagging indicator. The way the Bureau of Labor Statistics captures shelter costs, that's going to turn. It could turn pretty sharply in the next couple of months. But that last component of core inflation, non-shelter services, that's really being driven by wage costs. So for those that follow the Fed, know that they have two explicit goals. One is to keep inflation at 2%. The other is sort of given that maximum employment. This is a picture here looking at job growth with the vertical bars going back the past 20 years as average monthly job growth, and then our forecast going forward, and then the line shows the unemployment rate. So really what I would point out here is, 21 and 22 were some of the strongest job growth we've seen in the past 20 years. It is slowing, but it's not slowing that rapidly. With the May employment report, we saw another over 300,000 gain in employment. And over the past 3 months, we've averaged almost 300,000. That said, that's weaker than what we saw for much of 22. The unemployment rate, which in April was at 3.4%, which was the lowest we've seen since 1969, jumped up to 3.7%. And we think, for all the reasons I just walked through, economy likely to slow pretty markedly in the second half of this year. And with that, job growth will first slow and then go negative. So we're still expecting for the year an average job loss. And if that's going to happen, we're going to see the unemployment rate go from that 3.7 as of May 2023 to somewhere about 5% in the first quarter of 2024. Now, by historical reckoning, that's a pretty modest recession, a pretty mild downturn. Then we expect a recovery coming out of that. Just by comparison, you can see here, coming out of the great financial crisis, the unemployment rate got to 10% and was very slow coming down. We're not expecting anything like that, but definitely a slowing in the pace of job growth. We're already seeing wage growth slow. We're seeing the number of job openings, while still high, come down. We're seeing layoffs increase. Initial claims for unemployment insurance picking up pretty quickly in the last couple of weeks. So still comfortable with sort of the general pitch of our forecast here. We're actually rolling out a new forecast either tomorrow or Thursday that'll hold to generally the lines that I'm talking about here with respect to the job market. Okay, so to the first question, what does all this mean for rates? Obviously, for rates, you got to be a bit more specific. First, starting with treasuries, Are you talking about the front end of the yield curve or the long end? We are in a wild time right now. I just looked right before I got on. The 2-year treasury is 97 basis points higher than the 10-year treasury. You have to look back to 1980 to look at something similar. Again, not surprising, inflation got to the highest points of the 1980s. The Federal Reserve acting in a way they haven't since the 1980s. So we're in that kind of a 40-year sort of revisit in terms of economic measures, but you just don't see an inverted yield curve like this very frequently. And that also is another one of the factors I look at pretty closely in thinking about what are financial markets saying about the future of the US economy. A steeply inverted yield curve like that says markets anticipate the economy is going to slow quickly and significantly. And with that, the Fed's going to have to change course. All right, so what is the Fed going to do? That's the blue line on this chart here. They skipped, is the way the market's characterizing their June move, which after raising 25 basis points at the prior meeting, they didn't do anything in June. But in their economic projections, which they put out there as sort of their best guess of where they might be headed, they think they might hike as many as 2 more times this year. For the chart here, we don't believe them. And that's quite a thing to say, but we think given the pace that the economy is slowing, it's unlikely that they're going to raise even 1 more time this year. But that said, we will see how the inflation and employment stats evolve from here. Either way, either they're done or maybe they do 1 more hike in July. We think they're going to then hold it at that higher level through the remainder of 23, and we won't see a cut until 24 when inflation has significantly dropped. Okay, but I mentioned the distinction between the front end of the curve, the Fed funds, and the 2-year versus the 10-year. 10 years about 370 today, and mortgage rates. We've already seen the 10-year treasury and mortgage rates, 30-year mortgage rates come down from their peak in the 3rd quarter of last year. A little bit of a run up recently related to the debt ceiling drama and all that. But again, our expectation is that through the course of the next 6 months, we think rates are more likely to trend down. Now, what's one of the factors that really has prevented that? And that's this picture. So I kept talking about the 10-year treasury and the 30-year mortgage. If you look historically, that gray line shows the spread, the difference between those 2 rates. Typically, we'd expect that spread to be about 1.7, 1.8 percentage points. Right now, it's 3 percentage points. Outside of extraordinary financial crises, we just haven't seen the spread be that wide. So what is causing that? A couple of factors. One, with the Fed's really unprecedented 5-point move in short rates last year, interest rates are very volatile. That volatility directly translates into higher mortgage rates. Second, the Fed, in addition to raising short-term rates, has been shrinking its balance sheet, allowing its holdings of MBS to roll off. That's putting some upward pressure on mortgage rates. And then finally, I mentioned the bank failures. So Silicon Valley Bank and Signature Bank had pretty significant holdings of mortgage-backed securities. The FDIC is now liquidating those, so that's adding additional supply to the market. So right now, this spread, again, about as wide as it's ever been. But I'm sort of counting on red-blooded American capitalism to fix this situation. I don't know how many of you read Barron's or similar publications. They're publishing articles with headlines like, "This is a generational opportunity to invest in mortgage bonds. You won't get relative returns like this for long." Folks like PIMCOs and BlackRocks of the world get that too. This is really an extraordinary opportunity to be able to invest in mortgage-backed securities. Once people start doing that, that spread will come in. And again, you look at the history, when it comes in, it tends to come in pretty quickly, and that'll bring that mortgage rate down in line with our forecast. All right, let's move over to the mortgage side of the world, having talked about rates quite a bit. So first, I'm going to start with some data from our weekly application survey. The red line here is just looking at refinance application volume. The blue is the mortgage rate. They tend to look like mirror images of one another. There's not a lot to talk about with respect to refinance right now. So many homeowners locked in at record low rates. the refinances that are happening are cash outs, or maybe someone that had mortgage insurance and now can lower their payment, even if they don't lower their rate. So not a lot to talk about there. So let's move on over into the housing market. And good timing for this call today. There are quite different stories if you're talking about the market for new homes versus existing homes. So the news out this morning is residential construction in May. Single family starts jumped to a seasonally adjusted annual rate of almost 1 million. Combine that with data from our own builder application survey, or what you're hearing from builder earnings calls, this might be one of the best environments for builders that we've seen in a really long time. And we're now forecasting growth in new home sales in 23 compared to 22, because builders are stepping into the void of the absence of existing home inventory. And many builders have moved down their price point to the extent they could to reach the really phenomenal first-time home buyer market that's out there. On the other side, while we're predicting an increase in new home sales in 23 compared to 22, we're predicting about an 18% drop in existing home sales. For so many owners having locked in those record low rates, they just have not felt any need to list their property. That's not going to last forever, and happy to talk more about that during the Q&A. But for right now, for 23, it is a real headwind in the existing market. So what's going on here? And again, I mentioned sort of why might people move even if they locked in that extraordinarily low rate. And here I'm borrowing from some friends and colleagues at Freddie Mac, what I think is just the best way to show sort of what's going on and to what extent are people willing to list their homes. So the chart on the left is looking at the share of home buyers who moved within the same county. And you can see that's dropped just like a rock, right? So if you've got a 3% mortgage and you're looking at a house across the street, it's pretty tough to justify that move, particularly given that you'd now be paying a rate in the 6s as opposed to a rate in the 3s. But if you look at the middle chart, if you're moving across the state or moving across the country for family, for job, what have you, that pace of moves really hasn't changed very much, right? Maybe it's even increased a bit. Then you add that to the chart on the right. If people are moving, they're much more likely to move out of a more expensive top 25 metro rather than into, right? And move to just about anywhere else. So now think about the combination of the ability for increasing amounts of remote work, maybe a hybrid schedule that lets people go in less than 5 times a week, and they'd be willing to do a long commute 3 days a week, but maybe not 5. That means they're finding a way to make this market work for them, right? They might be willing to give up that low rate on their current home to go get a bigger home or a different home in a less expensive part of the state or the country. And Black Knight did a great study sort of along these lines too, just saying, okay, what would be the minimum level of housing turnover of listings that we could see? Well, if people just put all financial reasons aside, they're still going to get married, they're still going to have kids, they're still going to get divorced, they're still going to die, unfortunately, and they're still going to get new jobs. And if you look at the level of existing home sales needed just to support those non-financial reasons, that's about where we are. We're about as low as that can get. And I think the further we move away from those record low rates, people are going to get more comfortable with these other kinds of trade-offs you make in life, and that'll bring some additional inventory online. But for now, it's a builder's game. And for those that are active supporting the new home market, I think this picture is pretty compelling, both looking at the reduction in inventory that we've seen over time, and particularly in recent years. But then now, where typically we would expect 5 to 10% of inventory on the market to be new homes, now it's almost 30%. And given those starts and permits numbers this morning, there is more coming. There's still about 700,000 homes under construction, and that'll hopefully eventually add to some of the inventory we need. Okay, so I talked about the supply side. Now let's go to demand. The demand side has been a compelling, bullish story for some number of years. On the left here, just showing the distribution by age of the US population. The yellow portion in the middle are the millennials, 28 to 38. There's 50 million of them. I think those are all of Dave's kids are in that group as well. So compelling demand. These are the ages where people are more likely to form their own households, whether renter or owner. Peak first-time home buyer age, 33 or 34. So this group is right there. And that chart on the right is just emphasizing that point, where the gray is showing the home ownership rate for those under 35, the yellow for those between 35 and 44. And you can see this is just the age where housing demand jumps and home ownership demand jumps. And I think that's what we're seeing in the market. We're seeing an increasing share of first-time home buyers wanting to get homes, but per the earlier discussion, really, really challenging to find those properties. But I think more and more have sort of reached a mindset where they're not going to get a 3% mortgage rate. They know that. They're comfortable with a 6% mortgage rate. They'll jump into the market when it's at 6. They might fade when it's 6.5 or 7. But per our forecast, if we think we're going to be low 6s and maybe below 6 by the end of this year, that'll help this incredibly robust, demographically driven demand. Of course, that's running into the lack of supply. And here just showing by decade how many housing units have been built over time. And you look from 1970 to 2009, we were regularly in this country building between 16 and 18 million units. When you look across single family, detached, attached, small multifamily, large multifamily, manufactured, anywhere somebody could live, 16 to 18 million units. From 2010 to 2019, post-Great Financial Crisis, we built 11 million units, right? That's why we're in the straits we are with respect to the lack of inventory. So we need builders to sort of keep their foot on the accelerator to build some more. And then you see in the 2020 so far with the pandemic, we sort of only dug the hole a bit deeper. Okay, so all that reflected in the level of activity we're seeing in mortgage on the purchase side. So each line is a successive year. The bottom one is 23. We're running about 25% behind where we were last year at this time. But again, we could break this out and show you it's a very different story if you're looking at purchase activity volume for new homes versus existing. On new homes, we're equal to or above where we were in 22, but far below on existing. So this really is a supply constraint story. It's not as much a rate story as it was in 22. So in terms of mortgage lenders, we're expecting another tough year all in, given everything I said. So looking for about a 20% drop in volume in 23 compared to 22. But then as rates come down, as some additional inventory comes on due to the work of builders or owners sort of reaching a point in life where they're ready to let go of that low rate, we expect a recovery in volume, particularly on the purchase side in 24 and 25. Last couple of thoughts, given that drop in volume, a lot of lenders struggling. So, I mentioned the bank failures. I wouldn't be surprised to see a lot of consolidation in the mortgage industry over the course of 23 and 24, given the tough market. As of first quarter of this year, only about a third of mortgage lenders were profitable. So very, very challenging environment for a lender to operate in. And then last thought, I believe, is looking at delinquency rates. I mentioned that the unemployment rate had reached the lowest level since 1969 and only picked up a bit in May. Typically, if people are employed, they're paying on their loan. So we're seeing that in the third quarter of 22, we saw an all-time low in the delinquency rate. And, if we're right and the unemployment rate rises from here, expect this will go up. But often I'm asked, well, is this just going to be a repeat of 2008? And my answer is that the circumstances are so far different. 2008, we had too much housing inventory. Now we don't have enough. 2008, we had delinquencies that really skyrocketed at the first sign of weakness. That we're just not seeing it now. So really a very different environment that we're operating in. So Dave, hopefully I got to the two main questions that you had posed, but let me stop there and we can take it into conversation from here.
Thanks, Mike. Steve, you have anything you wanted to jump in with?
Well, there's questions in the chat that you can peruse and go through if you want to. Some good questions. It's interesting though, with the inventory thing, you talk to any builder, it's hard to find good workers.
Yeah.
I mean, you talk to track builders, but any custom builder, they may tell you it's going to take 2 years to build a house. I mean, when you hear that, Michael, what's your thoughts on just trying to find the workers for these builders so they can continue building? What's your first reaction to that?
Yeah, so my counterpart at the National Association of Home Builders talks about the problem with the L's, right? So land, labor, laws, lumber. Those are the challenges that a builder faces. Not enough lots ready to go, not enough skilled trades, as you indicated, regulations that are adding about $90,000 to the cost of building a new home. And then lumber certainly was an issue last year with the supply chain constraints. It's interesting. I'm hearing a little bit less about the labor issue from the big guys, as you said, the big public builders that are putting up a lot. But totally agree that the smaller builders probably more impacted. And even beyond that, the credit issue that I mentioned, it's going to be tougher for them to get AD&C loans from small banks the way they did previously, given the challenges the banking sector is in right now with the loss of deposits and the tighter regulatory scrutiny. So I'm expecting more of the building share to go to the big publics and less to the smaller private custom builders. But to your point, they absolutely face the constraints with respect to not enough skilled tradesmen out there.
Hey, Mike, there's a bunch of questions here about builders and why didn't they build more? Why aren't they building more now? Granted, you just talked about starts are up, but it seems still relatively tepid, especially when you look at that historical data. Is it all supply chain and labor? Is it the 4 Ls, or is there more to that story as to why they didn't start building in your mind?
Well, coming out of the great financial crisis, they were just decimated. They had been, to use a Dave Stevens phrase, over their skis quite a bit in terms of, really overextending the land commitments they had and sort of missing the market in terms of where demand was headed. And so you saw a lot of builders go out of business, and that has had just sort of lingering effects, right? And with the labor point too, right? If you were a carpenter in 2011, you probably weren't taking on an apprentice for several years, given the lack of business. And so now we got this hole in the labor force. So now I think, as I said, I think the big public guys are gearing up for more activity, but they're also, in many ways, more financially conservative institutions than their predecessors, and they have shareholders to answer to. So they're looking for consistent returns over time. They're going to grow, but they're going to grow in sort of measured steps as opposed to trying to seize the market opportunity all at once.
There's a couple questions about, one question about lenders and competition and margins and how is that going to resolve itself. Why don't we start with that one, and we'll talk about, and then I'll tag on, Mike, after that, if you want to talk about what do you think about banking risk? Are there going to be more failures like we just saw? But let's start with the mortgage industry first. And how do you see that playing out to bring margin back to the business? And will margin come back to the business?
Yeah. So if you remember that origination volume slide I showed, so we peaked at 4.4 trillion in 21. That dropped 50% to 2.2 trillion in 22. We think it's going to drop another 20%. So 70% drop in volume. And so some people thought, well, does that mean we have to have a 70% drop in industry employment to get margins back? We don't think so, because in 20 and 21, lenders operating in a pandemic weren't able to hire the way they would have wanted to. So, I mean, they were just swimming in business and understaffed, under capacity for a good portion of that. So now our forecast was we probably need about a 30% drop in industry employment from its peak in late 21. We're about 20% down right now. Given some of the announcements in recent weeks, we're I think well on the way to that 30 number. That'll mean a return to sort of normal levels of profitability, as opposed to what we've been reporting the last couple of quarters of lenders losing $2,000 in every loan they were making, right? Which is obviously not sustainable, and I think is going to lead to a lot more consolidation to try to make sure the fixed costs of the business are going to be manageable through a cycle.
Thanks for that. Can you talk a little bit about the banks? There was a question, do you see more bank failures coming? Obviously, this underwater basis risk these guys fell into. Is that an anomaly? Is it more widespread? What do you see happening in that sector?
Yeah. So, the Silicon Valley Bank, Signature Bank failures over that one weekend in March, I think caught many people by surprise, including the bank supervisors and regulators and folks here in Washington at the Federal Reserve. That was a shock. Prior to that, we had Silvergate, which found themselves effectively insolvent and liquidated the institution without going into receivership. At that time, you had this long list of regional banks that, similar to what we saw in prior financial crises, really became targets where the financial markets were sort of probing to see, okay, who has weaknesses, who's losing deposits, who's got unrealized losses that they're not going to be able to handle. First Republic was at the head of that list, and they eventually did fail after sort of a couple of months of hiatus. I don't think we're done yet. Those institutions really were hit, as you said, by losses on their securities book, their loan book, just as a result of the shock in rates. I think what's coming next are some credit losses, which are going to be pretty large, particularly for those that have concentrations in the office portion of commercial real estate. You mentioned that we have members, about a third of our membership active in the commercial space, and talking to folks that are really well informed here, they can't quite get a bead yet on how much the valuations are going to drop as a result of return to office not happening in many markets across the country. Office values could drop 30%, they could drop 70%, and it's going to be market by market, property by property. And if you have a loan against that property, that could be a big problem real quick. So I think we'll see in the Q2 bank earnings, which will be out sort of mid to late July, some early indications of sort of, again, markets will draw up a list of sort of who's most in danger. But I'm going to be surprised if we don't have several handfuls more bank failures through the course of this year as a result of those credit losses. And I think that just adds to the credit tightening story I was indicating. A little bit less so in mortgage, right? But one way we'll see it is, last year, most banks were putting a significant portion of what they originated on portfolio and really aggressive about it because they had access to cheap deposits. So we saw jumbo rates that were 50 basis points below conforming rates. And, Dave, you and I, when we were at the GSEs, typically conforming was 25 basis points below jumbo, right? So that's inverted over time. Right now, they're about even in our survey data, but I think you could see jumbo rates moving even higher because that bank portfolio bid has gotten much, much weaker. And what we've heard from a number of our bank members is they were told from the top of the house, look, there's not space on the balance sheet for your loans. If you don't have a secondary execution, we're not interested. So that's going to be sort of the tenor from a lot of the banks out there.
Yeah, that leads, I don't expect you to weigh in here, Mike, but that's why I've been writing recently in Housing Wire about that delta, that gap between how banks are going to look at the bid for mortgages versus how independent mortgage bankers like Steve Jacobson's company here, Fairway, the way they play in the market. It's really important to look at an independent mortgage banker when if you're going to have a bank as someone quoting the rate to you, make sure you also check with someone like Fairway, because there could be quite a difference between their comfort with credit risk as well as how they may price a mortgage.
Makes sense to me.
You didn't talk about home price appreciation expectations or depreciation. One of the common questions I get, and I think you answered it because you showed such an incredibly low supply of available homes for sale and this incredible wave of demand coming in from that huge millennial wave that's heading our way. But do you have an expectation around home price appreciation or depreciation over the next, I don't know how you look at it, quarters, years? How are you thinking about it?
Yeah, so last year at our annual convention, we sort of made the remark that our expectation with home prices nationally essentially flat in 23 and 24, but we'd probably see a quarter or a few quarters with negative year-over-year nationally, but not a home price decline event, but a very different world from the almost 20% year-on-year home price growth we'd seen in 2021. At the time, we looked very optimistic compared to a lot of forecasters out there. You had a lot of the Wall Street folks saying, 10% decline nationally, 15% decline nationally. And we just kind of held to our guns and said, look, given this inventory situation, it can't happen. It can't happen that you'll get sharp declines. But again, that's a national story. When national prices are flat, you can expect about a third of markets around the country to be showing declines. Right now, those declines are concentrated on the West Coast, Bay Area, particularly Seattle, some in the mountain states, places like Boise that were the beneficiaries of a tremendous amount of pandemic-driven migration. Some of those folks went back to the office, and so Boise got a little too overheated. We're seeing some declines there. But in the rest of the country, particularly the South and the Southwest, prices are going up. So more likely than not, our overly optimistic forecast in the eyes of some, we're going to start marking up. Flat may be literally like no declines at the national level, may be where we evolve over the next couple of quarters. But certainly not expecting a big decline nationally. And again, there are different stories in different markets, with the Bay Area being really hard hit, both on the commercial side and the residential side, with all the tech layoffs that have been announced.
Hey, Mike, so someone raised the point, which I think is a good one, is that, they're still seeing banks price jumbos better direct to their borrowers than through their third-party agreements, correspondent or wholesale, if they're doing jumbos. And I think what you were saying is you shouldn't expect that necessarily to change. You didn't address that, but what you were saying is that the spread between jumbos and conventional pricing will widen because banks have less of an appetite for mortgages generally because of all the interest rate risk associated with it. But it doesn't mean that they'll change their strategy necessarily, and the spread between third-party pricing and retail pricing, that probably won't change. I don't know if you agree with that kind of view.
I do. I think, speaking at a really high level, bank strategy with respect to mortgage has been sort of one of two brands. One is mortgage is a business, and I'm going to run it like a business. I'm going to run multiple origination channels and have a big servicing book and try to do portfolio retention there and think about it as an integrated business. Or it's a product. It's a consumer product I offer along with everything else. I give a better deal to my retail bank customers. The objective is to have as many products with that retail bank customer as I can, and mortgage is just one. We've seen more and more banks move from that first strategy to the second. Wells Fargo being the biggest example, but you have a lot of others that are, I expect, following in that path. And a question I asked some bank leaders shortly after that was, when Wells made that announcement, did you get a call from your bank CEO or your board member saying, what do you know that Wells doesn't know? And they all kind of chuckled because they all got that call. So I think the expectation is more and more banks being pushed in that direction.
So
Any
David,
other questions?
David,
Go
I'm
ahead,
gonna,
Jake.
I'm gonna share something with you and just get Michael's and your view on this. You know, when you talk about what the banks are doing and you talk about, we get so fixated on price, but what we don't realize is what is somebody getting paid for those loans to originate them. And it's almost like, and I hate saying it this way, but we were raised in the 80s and people say, well, I wasn't born in the 80s. What do I care what you guys say? But it's like back in the 80s, you got paid X amount per loan. If people would just pretend like they were rookies for a season, for like the next 6 months to 9 months and say, I'm going to get paid less per loan and not worry about it. If people would take that stance, David, what's your opinion of that? Because to me, I'm kind of old school this way. I mean, when you're, and Michael's going to roll his eyes, say, how old are you guys? But David, there's years where our average loan was 40 to 50,000, making 200 to 250 per loan.
That's
And when
right.
people hear that, well, you're an idiot. Well, it's like, okay, so I'm an idiot, but that's the learning we took to get into this industry to get to this point. So it's kind of like if loan officers would just take a stance and say, I'm going to be a rookie for a while, and I'm going to not worry about what I get paid. I'm going to get paid less per loan, but I'm going to do more volume until all this shakes down. What's your first reaction to that? First, David, then Michael.
Well, I think that's a natural occurrence anyway, right? I mean, I'm looking at Scotsman's Guide. You're ranked as the #3 retailer in the nation for 2022. And there's other year-to-date figures that have you up there as well. You've actually grown market share, I think, Steve, since the 2021 period. And it certainly isn't by a bunch of loan officers making more per loan. I mean, I think right now this is a very defensive market, and you have to be defensive strategically to protect your relationships. And that probably means working for less per loan. And to your point, I don't know, everybody knows that Steve and I started in the business 1 year apart from each other as loan originators back in the early 80s. And you're right. I mean, I worked for a couple $100 a loan, and I got paid $50 for a second mortgage, I remember. And you had to do a loan every day in order just to make a living. But yeah, we did get spoiled. And one of my greatest concerns, using the analogy that the apple falls harder from the highest branch of the tree, we fell off the biggest branches of the biggest tree ever created in mortgage origination history. And that was the COVID pandemic years, when the Fed really jumped in March of that first year, and we had just incredible mortgage origination years that defied historical norms, and a lot of money was made, good for everybody involved. But now we're back to a more normalized market. If you look at Mike's forecast, we didn't spend a lot of time in that chart, but if you look at his purchase forecast, just for purchase transactions going out the next couple of years, 2025 could end up being perhaps the second biggest purchase year in American history by Mike's own chart in mortgage dollars. But even I think in your forecast for units on the MDA website, it's also going to be one of the biggest mortgage years in American history for purchase transactions. And by the time we get there, there'll be less competition. As Mike talked about, we are right sizing as an industry. Margins should be better. The industry should be more normalized in terms of employment, supply of loan originators. We're really headed in a good pathway here, but in the short run, clearly, I think the way you get by right now is you defend your relationships, and defending your relationships may mean making a little less per loan, but that will pay off in spades as this purchase market continues to grow over the next several years. And you have Mike's forecast right in these charts that he presented today to tell you how big it's going to get.
The only thing I'd add there, and I thought it was interesting, your focus on the retail business. I think we've done the experiment now to sort of see whether a call center model can be as effective in a purchase market. And just from data I've seen, there are a couple of companies that have been successful with that, but most are not, right? And it's very, very challenging, particularly in a market that's so tilted towards first-time buyers, to to think that that kind of a model is really going to be as effective. And so I kind of expect that over this next couple of years, purchase dominated origination volume, as you said, Dave, it is kind of old school of having to understand that you have to develop relationships with the realtors and builders to get this business. That is the way this game's going to be won. I think over the near term, the call center model is very effective in a refi boom, but again, outside of a couple of institutions that have managed to find for their specific clientele a way to make it work in a purchase market, it seems really tough.
So David, I'm just going to ask this question that Brian's asking, sort of what impact do you see the struggling commercial real estate market having on the residential market?
When we get that,
That's for you.
yeah.
That question, Michael's coming from Seattle.
Yeah. So it's going to be indirect, right? So I talked about banks tightening credit criteria because of the outflow of deposits they had earlier this year. I think several more notches will occur if you have bank failures or substantial hits to bank earnings or capital as a result of losses on commercial real estate loans. So it is going to be banks pulling back even further on all their lines of business, including mortgage. Mortgage, you do have the benefit of having this really robust secondary market so they can originate and sell. But I think even in that case, I think the banks are just going to be much more conservative about lending across the board, including mortgage. It'll put some additional upward pressure on jumbo pricing, anything that would be bound for a bank portfolio. And the other thing that you see in the jumbo space is much more regional variation because you just don't have the national secondary market that's determining prices. It's much more influenced by that bank's deposit mix, that bank's sort of credit posture. So it could have a big impact. And in a place like Seattle, yes, that's one of the markets that I know folks are watching, but Bay Area being the one that's got all the headlines right now about the unbelievable drops in commercial real estate property values.
So David, going back
at
to
the end of the day, I was just going to, and Mike, I'd like to test your view on this one. It's going to be hard on a lot of commercial real estate owners because just truly the cost of financing is about to shift, and anybody that's got some form of balloon financing is going to go from a very low single digit financing structure to something that's a lot more expensive. And that's just going to change the entire profitability picture for these buildings. But ultimately, the elasticity of the market will ultimately bring back in lower rents and lower pricing. It's just going to be a painful slog. And to Mike's point, the banks are going to be, particularly hard hit, the ones that finance a lot of these properties if it ends up being a big correction. So I don't know if that makes sense to you, Mike.
It does.
Go ahead.
So David, slicing through this, and this is, gosh darn it, doing this almost 40 years, it kind of drives me crazy because the answer isn't that complicated. Like you said, build the relationships, make less per loan, and don't worry about all the stupid stuff. Let Michael worry about it and give us updates once or twice whenever, but don't read all this stuff to drive you nuts. Just go out and originate loans and cut your commission. You say, Jake, you understand. Listen, David, back in the day, we had to close 30 loans a month to justify doing this. And you say, why do you keep saying that? Fairway wouldn't be here if that process wouldn't have went through. Not that nobody cares about that, but it's the truth. That's what we had to do back in the 80s.
Well, even think about, I know there are several realtors on this call as well. Mike just gave the tools. I mean, Mike's one of the top economists in this country, and my go-to, frankly, for great data on the market. And the MBA is lucky to have him. But he just showed a slide at the end of that presentation, that slide with the demographics that shows the population distribution in this country. On the left and on the right side, it showed the incredible change in home ownership rates once you go over age 35, just one tier above, one cohort above that, essentially. But that picture says to me, if I'm in sales now, I'm not Mike's job of just conveying information. We are on the front doorsteps of the biggest wave of home purchase demand that this nation has ever seen demographically. The data is right there in front of you. We didn't have that in the 2008 recession. That was Generation X. It was a smaller generation. We were actually losing household formation on an annual basis, sometimes as much as 600,000 households per year we were losing, where right now we're gaining them by 1.5 million or so a year with this current demographic. To your point, Jake, I think you use the data to learn and be knowledgeable, but take the best of it and transform it into something you can use to motivate home buyers when it makes sense to take a look at this and say, man, I better jump on this, I better jump on this horse now while I can get onto it, because we don't have any big massive change of supply coming our way, and we have a big increase in demand coming our way. Rates are going to come down over the next year, probably couple of years. And I can always refinance that one, but I won't get a chance to buy a home, even at current levels for some time to come. Mike said it himself, worst case flat on a national basis, and then likely home price increases from that point forward. And that's in his other data that he shares on the MBA website. So I think there's great ways to use data like this to make yourself go out to others and help them feel more empowered to make the decision to go buy a home. And if you help teach your realtor partners this and share the same information, it gives them empowerment as well. And to your point, Steve, you got to cut out the negativity and focus on the opportunities in the market. And it's only going to get better. Everything Mike told you here is telling you this market is only going to improve over the next few years from where we are right now. So it's a good place to be, I think.
Mike, where do we follow you on socials? Because now that, that's kind of like the thing. So how do we keep track of what your thoughts are and where you share what you're thinking?
So I think the easiest way is just follow MBA on LinkedIn. They put out my stuff all the time, along with the other analysts and economists from my group. So that's the easiest way. You can also follow me on LinkedIn as well. But I think that the MBA one is the best way to do that.
David, what's the one question we didn't ask Michael you saw? Why didn't we ask him that? But what from your perspective? What's the one, as we close this out, is there another question we should have asked Michael?
I love the way Mike presents, because he doesn't spin it, right? Mike just shows you the data. And the thing for me that I think is, I don't think enough people really recognize is the incredible value of that information that he shared today, because it's nothing but optimism. The only negative point in that entire presentation was this year is going to be down about 22% or whatever your percentage was. But then you a few years, we have nothing but growth ahead. And if you're a real estate agent, you ought to see where you sit right now. We haven't had many markets like this in American history, where you're literally on the front steps with so much purchase demand coming your way. We had big years, and COVID years were big years. 2020 and 2021 were huge, but there were other forces driving that. This is, the fundamentals of this economy for housing are not great for this year, but the building blocks you're putting down right now are going to be really valuable for the next few years. And all of that data was in that presentation. And I think people should take the deck. I'm going to send it to Kathy afterwards. I know it's being recorded also and will be shared, but I'll send Kathy the actual hard copy of the PDF. And you guys should look at it and take that and build it into your dialogue that you use out in the marketplace.
Fantastic job, Michael and David. As always, we appreciate you guys. And if there's something, David, you in the periphery that you think we should be looking at, just let us know, big boy. Fair?
Will do. Mike, thank you so much for joining the Fairway team.
Thank you, guys.
Appreciate
Appreciate it.
Thank you.
Take care, everybody.